Good day, traders, and welcome back to another weekly dose of market insights with me, Zain Vawda, your analyst here at OPT. So yeah, before we get started, guys, I think let's just look at the agenda for today. What we will be covering will definitely be a recap of last week. Obviously, we had that jobs data, which was quite a big deal at the back end of last week. And then this week ahead, we will cover what might be moving markets here. We do obviously have the ECB interest rate meeting coming up. We do have some US data, Chinese data, as well as UK data to unpack as well, and what influence and potential influence that might have on the markets. We will take a look at that as well. And we will wrap things up quickly with some technical analysis and a look at a few charts, which is what most of us always enjoy the most. So if we can get things started, I think let me just share my screen first, guys. I think we will start just taking a quick look at the calendar, just to give us an idea of what we do have coming up this week, if I may. Economic calendar, there we go, guys. This is obviously the economic calendar from Trading Economics here, as you guys can see pulled up on my screen. Now, this morning already we did have some data, guys. Chinese inflation rate. Now, this was a really interesting one. Chinese inflation data has been really sticky. You know, China, one of the few countries, they're not struggling with higher inflation like the rest of the world, quite in a similar position to Japan as well. Now, the interesting thing with this week's Chinese data, we did expect a slight increase, and we did get that, the inflation rate ticking up slightly higher, particularly where food was concerned. You know, food inflation was one thing which was really low for the longest period of time in China, and this is something that will be welcome, obviously, especially for businesses as well that deal in food products as well. So something to keep an eye there. However, the one thing about Chinese data that was really interesting, guys, is when you look deeper into the inflation data that was released this morning, it does paint a pretty grim picture as well. Some deflationary concerns as well, particularly around the housing market. We are seeing housing prices struggle. Obviously, that is now down to a lack of demand. So demand and supply factors here factoring in as well with the Chinese economy. And obviously, there has been growing concern that China will not reach their target of 5% GDP growth this year. And obviously, just looking at what we are seeing from inflation and the housing market in particular, these fears continue to be or can continue to increase, if I may say so. So what we are seeing is, with Chinese data, this knock-on effect that this might have, this inflation data that came out this morning, particularly from the housing front, it's going to keep those recessionary fears heightened, especially particularly around China. Obviously, we do know the knock-on effect that China has on global markets. If we see a slowdown in China, that usually ripples, and it's usually a sign, actually a precursor with the import and export numbers in particular, that demand is faltering in the rest of the world. Now, another thing that we might look at later this week when it comes to China would be Chinese auto exports. That would be vehicle sales. The one thing we have noticed is a slight decline in that arena over the past couple of months, and that looks set to continue. Now, if that continues, obviously, guys, another sign that obviously we are seeing weakening demand globally for Chinese products. That obviously then affects things like raw materials as well, because if China obviously producing less vehicles and have less demand, then they will obviously purchase less raw materials as well. So pay attention to further Chinese data out this week, guys. I believe there is some more data to come later in the week from China as well. But for now, like I said, that's the one. I think tomorrow, guys, is the important one. On Tuesday, actually, Tuesday morning, we have the exports and imports numbers. That's where we will get more info on that, vehicle exports, which will play a big role, like I said, in seeing the demand side picture, especially, and how China is dealing with that moving forward. Now, having said that, guys, I did mention some of the other important data we do have. Coming out this week, we do have that ECB interest rate decision, which is due out on Thursday. Besides that, from the US, we don't have a huge week. And the reason I say that is we do actually have inflation numbers, both CPI and PPI data this week. But obviously, looking back at, what's happened over the past couple of weeks, labor data now seems to be the driving force for markets rather than inflation, especially when it comes to what the Federal Reserve are going to do moving forward. So when we take that into account here, like I said, PPI and CPI data not holding as much weight as it did maybe a month or 2 months ago. So even though I do think that we might get some volatility around this data, I don't think it's going to have a massive impact on the actual rate cut expectations when it comes to the US Federal Reserve. Hence, any moves that we do get in response to this CPI and PPI data may prove to be short-lived. So just something to keep in mind there. Keep an eye when that data comes out and the type of moves we get in response to that data. But besides that, guys, like I said, the ECB decision, which is a massive one, on Thursday, markets are expecting another 25 basis point cut from the ECB, and I don't really see any reason to doubt that at this stage. I mean, We have seen, worsening economic data coming out of Germany, which is the most industrialized economy in Europe. So obviously, concerns there as well. We are seeing concerns the demand side as well in Germany, with vehicles as well playing a role in Germany, just like as we mentioned China as well. We are seeing quite concerning developments in the vehicle manufacturing space in Germany. I know last week there was news that BMW and a few of the other car makers are looking to close some factory plants as well in Germany, in what would be a first. Such a move would be one of the first times I think we've seen that in the German auto industry, the size of the factories that they are looking to close. So these are all pointing to signs, guys, of a slowing global economy. So something that has been gaining traction over the past couple of weeks. So a lot to pay attention to there. Now, before we actually just get into the week ahead things, guys, just to look back quickly, why I say this demand side has become so important is that if we look back at the labor data last week, which came out on Friday. Now, I know markets were a bit spooked initially. We did see quite a bit of back and forth in terms of rate cut expectations. And I think the data itself wasn't a huge change up, or wasn't huge deviation from what was expected. However, looking deeper into the data, and it does paint a bit of or does give you a bit of insight into why there is concern around the US economy. Now, if I may quickly, we did obviously see, the NFP print come in slightly below estimates there, which wasn't a big miss, as I mentioned. However, I think the biggest thing that to take away, if I can just switch the screen up, guys, the biggest takeaway, I think, for me from the data was actually looking at the jobs that are being created in the US. And this is one thing that, has been cited by quite a few economists of late, that the jobs that are being created in the US at the moment, we are seeing a lot of part-time jobs that are being created. Thus, the US is losing full-time workers, quality jobs, and replacing that with part-time workers, which is why we've seen such a strong jobs numbers for the majority of this year. Obviously, we did have that significant downgrade recently, which did finally show that there are some cracks appearing in the US labor market. So I think this concern here, as you can see here, guys, we do have this deviation, the orange line obviously showing full-time employment, and then you can see part-time. You see that massive deviation that we are seeing now. We did see this before as well in around 2008, just before we had the previous recession as well, the dot-com bubble. This is usually seen as a sign of a pending recession. It's usually one of the indicators for a recession. So this is why we are seeing those recessionary concerns, rise basically. But since then, like I mentioned, guys, after that data and after everything settled, markets do seem to be convinced now that we will not get a 50 basis point cut from the Federal Reserve. And I think a lot of that was down to the actual print on the side of the when it comes to the unemployment rate in the US, which actually improved slightly. But like I said, once again, that might be misleading, as we seem to be creating a lot of part-time work in the US. Apologies, guys. But yeah, that seems to be the biggest problem at the moment, I think, for the US economy. And that's the concern that's bleeding across into global markets. So that is something to pay attention to. But now, if we can, guys, switch over to the charts. I know that's why we all here. I would like to get through quite a bit today on the charts. Let's see if we can kick things off by looking at the dollar index. There we go, dollar index. If I may share that. Let us take a look, guys, what we have here when it comes to the dollar index. Now, as you can see, guys, we have seen quite a significant jump. And this is obviously reflected in the start of the week here, what we are seeing in markets. It does seem to be as if we are seeing a bit more risk on trades at the start of the week here. We're seeing the dollar index rise. We're seeing quite a significant recovery in some of the US indexes, which fell a little bit last week. We will touch on that shortly. But just looking at this dollar index, guys, I did tout this level down here as support at around the 100.50 mark. This key level, where we have seen previous bounces in the past, going back to, I think it was July of 2023 as well, serving as a key area there. So we did get a bit of a bounce there on Friday after we got that bit of whipsaw price action there after the jobs data. And now it does look like we are forming what you would call a morning star candlestick pattern on the daily chart here. Now, with that in mind, can the dollar index push on? I think that's going to be the key question this week. Now, like I mentioned, that CPI data not holding as much weight as it did in the past. With that in mind, there is a real chance that we could continue to push on towards the next area of resistance around the 101, 120 mark, or the ski level here, if you want to call it that. That was the previous swing low on that August 5th sell-off, guys, as you can see down there. And that's why, obviously, I do have this level marked off as a potential area of interest or potential key area to pay attention to. So, yeah, with the dollar index, like I said, guys, just looking at the way price action is forming here, obviously having taken out the previous swing high, forming a new higher high, now a higher low. You would expect a new higher high to be printed, and thus, it brings it towards that 102, 160 key level up there. So that's what I will be paying attention to this week to see if that dollar index can continue to move higher. Now, going across, obviously, to US equities, guys, and as I mentioned, we did have that really interesting sell-off at the back end of last week. Let's just take a look at the S&P 500 if we can, guys. There we go. We have the S&P pulled up here. And now, if you guys can see, we are seeing quite a significant bounce here to start the week here. Bouncing off support once more, or key level here area that had held back previously. July, in middle of July or back end of July, we had a bounce there and a retest at the last, on the back end of July around the 30th. And then this level now obviously coming into play once more. We also have this 100-day moving average that's kind of providing some support for prices here on the S&P. Now, like I said, obviously, guys, we did discuss, seasonality recently. And looking at, how the US stocks generally perform around this time of year, and September is, known as being a very difficult month for US stocks. The other interesting thing, guys, that I did pick up around the stocks that I thought might be of interest is that last week we saw outflows again in US equity funds. Now, this is something that has been increasing of late. We have seen quite a bit more outflows from US equities of the last couple of weeks. You'll see now as I share this chart quickly for a second. There we go. Fund flows, US domicile equities, bonds, and money market funds. As you can see, guys, the orange is representing US equities. And as you can see, out of the last, we had 1, 2, 3, 4 weeks. Out of the last 4 weeks, guys, we've had 3 weeks where we have recorded outflows, and last week was the biggest week of outflows that we have recorded. So just a sign that there is a bit of concern at the moment around the equities. That also could be down to repositioning. Like I mentioned, notoriously, September is a bad month. We could be seeing, institutions cashing out of their positions, looking to probably get back in at a lower price if indices do experience a deeper pullback. So just something else to bear in mind there as well, guys. Lastly, guys, I thought I would touch on Brent crude. Oil prices, obviously, last week also seeing significant changes. Let's see, that's the right one. Yes, there we go, guys. Now, as you can see here, guys, we are still struggling quite a bit here on the oil side. Oil prices really struggling. Let me just open that up. Yes, there we go. Now we have dipped into a key demand area down here at the bottom, guys, around the 71 to 70 area. We did bounce a little bit there overnight, or on Friday actually, and then continued up a little bit, in the early hours of this morning. Oil prices, we did have OPEC finally provide clarity. There was rumors last week back and forth that OPEC would increase production from October. However, that seems to be put on the back burner for now. So, yeah, with that in mind, guys, I do think oil prices could get a bit of a bounce this week. However, like I said, just looking at the selling pressure at the moment, it is really extreme. The other thing to pay attention to here, obviously, we are seeing a bit of an increase again in tensions in the Middle East there between Israel and obviously Hezbollah from Lebanon, and the Palestinian resistance factions as well. A lot of things developing there pretty quickly. So keep an eye on that. Obviously, if that situation does deteriorate, that could explain any significant bounces we may experience in oil prices. The one concern here with oil prices, guys, as you can see on the daily, we are here creating a crossover here of the 100 and 200-day moving averages. Now, that's usually a sign of bearish momentum. However, important to note, as always, moving averages are a lagging indicator, guys. So a lot of this could be in response to the significant sell-off we have obviously seen over the last 7 or 8 days. So might not be as important as one might think, but just something to bear in mind that there is quite a bit of selling momentum at the moment here in oil prices. So yeah, lastly, guys, let's just wrap things up quickly on gold quickly before we call it. And let's take a look at this. Gold been another interesting one of late, guys. This is a 4-hour chart that I'm looking at. You can see I do have a key area here that I've been focusing on around 2,500, which is obviously a psychological level. And just above that, we do have the 100-day MA here at 2,504. Now, that obviously could also serve as, so that whole area basically from 2,500 to 2,504 could be considered a confluence area. So, bulls, if we are going to see bulls return this week, they're going to have to take out that area, obviously, to provide some, or to give some sort of conviction there for a move higher. Now, last week, guys, the interesting part on gold, or that I found really interesting, was response to that labor data. Markets failed to take out the previous highs. Now, we came really close to that previous high, or all-time highs in gold prices. However, the failure to take it out, guys, suggests to me that a lot of the interest rate cuts have already been priced in here when it comes to gold prices in particular. Obviously, we had that massive rally this year in gold, and I think a lot of the interest rate cuts have been priced in. So it's going to be interesting to see, guys, come the Federal Reserve meeting later in this month, when the Fed actually cuts rates, what will be the reaction of gold prices? Has the majority of it been priced in or not? For now, though, like I say, that's all I got for you guys today. I hope to catch you guys weekly for one of these videos, and I hope it adds some insight into what might move markets for the week ahead. But for now, have a good one, guys. Catch you soon, and trade safe.